Welcome to the T14B video lecture. This is where it's going to start to feel more like tax and less like economics. In this video, we're going to march through the federal income tax return for individuals and get a sense of how income taxes are calculated and reported. Your book describes the individual income tax computation as a four-step process. Total income, adjusted gross income, standard and itemized deductions, and the qualified business income deduction. I'm going to add two additional steps because we're overachievers. Calculate tax and apply credits and payments. Up through 2017, the Form 1040 was a one-page, double-sided form. In order to get the 1040 to fit on a postcard, it was disaggregated into a one-page, double-sided Form 1040. So it's only about half a page big, and 5 additional schedules numbered 1 through 5. This slide presents page 1 of Form 1040, the form used by individual taxpayers to report income and deductions and ultimately tax liability. The old Form 1040EZ and Form 1040A were eliminated. The top portion of the 1040 is mostly taxpayer information, but also includes some critical information. Of course, on a paper form, checking a box does nothing except placing a pencil mark on the paper. But these same choices when done in software make a big difference in the amount of tax. You can see filing status, the subject of the previous video, is right on top. Then the taxpayers and spouses identifying information. We'll see later that these boxes will affect the amount of a taxpayer's standard deduction. The little box on healthcare is also important, although less so as the penalty for no healthcare was repealed at the end of 2018. The bottom part of this page is where dependents are listed. This plays a role in a number of tax items, for example, filing status, single versus head of household, but also affects a handful of credits and deductions under the new tax law that we discuss later in these videos. Page 2 of the Form 1040 plays 2 roles. The first is to report the details of the most common forms of income for individual taxpayers. You can see these items on lines 1 through 5B, which captures wages, interest, dividends, pensions, and Social Security. The vast majority of taxpayers have income in only these categories, and so they're listed here rather than requiring one of the 5 supplemental schedules. Most of the other income will come through Schedule 1, from which the total is carried over into line 6. Line 7 serves as an important subtotal known as adjusted gross income. And if you have adjustments to income from Schedule 1, they are also accounted for on line 7. Line 8 is for the standard or itemized deductions, and don't worry, we're going to cover all of these later. Line 9 is the qualified business income deduction. Line 10 is the all-important taxable income, which, recall, this is the tax base for the income tax. Your tax is reported on line 11, along with any additional taxes from Schedule 2. Line 12 is for the child tax credit and other dependent credit, and any other credits reported on Schedule 3. Line 13 is just a subtotal. Line 14 is for any other taxes and is carried over from Schedule 4. Line 15 is your total taxes, so you can begin the settling up process. This is the total tax liability. Lines 16 and 17 capture payments you have made for income taxes and some credits that are treated like payments. You then compare line 15, total tax, and line 18, total payments, to determine whether you owe or they owe you. We can align these lines with the steps in your text. For example, step 1, that's line 6. Step 2, that's line 7. Step 3, that's line 8. Step 4 is line 9. My step 5 comes in line 11, and my step 6 is all encompassed in lines 12 through 18. Presumably now you can see why I added those 2 additional steps. Schedule 1 serves 2 functions in each half. The top half of Schedule 1 captures less frequent but still fairly common forms of income. Income from items like alimony, business income from a sole proprietorship on line 12, and from pass-through entities on line 17. Gains and losses, other income, they're all reported here. You can see that some of these, for example, line 12, come from a different supplemental schedule, in this case, Schedule C. Lines 13, 17, and 18 all come from other supplemental schedules, Schedules D, E, and F. Notice that the total from the top half of Schedule 1 is carried over to line 6 of the Form 1040 to become part of total income. The bottom half of Schedule 1 provides for a certain number of deductions in arriving as what is known as adjusted gross income. This is step 2. Adjusted gross income, or AGI, is a bit of a magical tax subtotal, and that a number of other key provisions use AGI as a yardstick to determine a taxpayer's ability to take or not take a deduction. Back when we discussed fairness and ability to pay, we considered a deduction for casualty losses, and we noted that the tax law used a floor of 10% of AGI to determine whether the casualty was large enough to warrant a deduction. That is the very same AGI we talked about then that we're seeing now. The taxable income needs a subtotal like AGI in order to avoid circular computations. For example, if the casualty loss were limited to 10% of taxable income, then taxable income would be dependent on the casualty loss deduction, which recall is dependent on taxable income, which would then be dependent on the casualty loss deduction, etc., etc., etc. As I mentioned, there are a small number of items that are deductible to get to AGI. These are called for AGI deductions, or sometimes referred to as above the line, AGI being the so-called line. These include a deduction for contributions to an individual retirement account, 1/2 of self-employment taxes, a deduction for alimony, which, by the way, was repealed for new divorces after 2018, and student loan interest. These are for AGI deductions because in theory, but not always in practice, these are not thought to be sensitive to the level of income, that is, the ability to pay. After completing Schedule 1, your summary totals on the 1040 should be complete through AGI or line 7. Of course, there are 4 more schedules, 2 through 5, but we'll deal with those all in good time. After AGI, the next step is the standard or itemized deductions. We're going to cover these in more detail in the next video, so you know they must be important. First off, be aware these are not all the deductions a taxpayer may deduct. In fact, deductions related to business or rental income are taken before this point and are reflected on the supplemental schedules to Schedule 1 under total income. For example, Schedule C or Schedule E. Itemized deductions are a narrow set of deductions that are personal in nature but are related to ability to pay. Rather than say more now, I'll ask you to hold your breath until the next video. For taxpayers with few or no itemized deductions, the standard deduction is available. The tax law permits the deduction of the greater of the standard deduction or itemized deductions. Next is the QBI deduction, or Qualified Business Income Deduction. This is a bit complex, and we'll unpack it later. But for now, know that it's designed to be 20% of your pass-through business income. Collectively, these deductions, the standard or itemized deductions, plus the QBI deduction, are known as from AGI deductions, or below the line. Okay, to summarize what we have covered so far, gross income minus 4 AGI deductions brings us to AGI. AGI less from AGI deductions brings us to taxable income. Since that is our tax base, we use that amount to multiply by the rate to get our tax liability. Although we are generally going to use the tax rate schedules we have seen over and over again. Technically, the IRS requires we use special tax tables for taxpayers with taxable income under $100,000. Okay, the overview is almost done, but we need to cover a few more items. After calculating income taxes on line 11, there are a few other taxes that are considered, such as tax on your kids' income and the tax on lump sum pension distributions. And then for good measure, they decided to move 2 additional taxes to Schedule 2. The AMT and the repayment of the advance premium tax credit. All of these are just a bit too deep for this course. Now we hit our first batch of credits. Consistent with placing the most common items on the face of the 1040, the child tax credit and other dependent credit are here. The child tax credit is $2,000 for each child and that is a dependent and under the age of 17 at the end of the year. The other dependent credit is $500 per other dependent that doesn't qualify for the child tax credit. We will deal with both of these in greater detail later. Before we go too much further on credits, let me explain the difference between a deduction and a credit. A deduction is an expense that lowers your taxable income, just like an expense lowers your net income. A credit, on the other hand, is a direct reduction of your tax. Some credits are even refundable, which means that even if you reduce your tax to 0, the government will pay you a credit above that amount. Let's look at an example with a taxpayer with $10,000 of gross income and a 20% tax rate. So if the taxpayer were able to take a $3,000 deduction, the taxable income would therefore decrease to $7,000. Thus, 20% tax is $1,400, and we're basically done. If instead the taxpayer were to take a $3,000 non-refundable credit, there's no reduction to taxable income. However, the $2,000 of taxes is reduced to 0 for the credit up to the amount of the tax liability. A refundable credit is even better. In this case, not only is the tax liability zeroed out, but the government is going to pay the taxpayer $1,000 just for filing a tax return. And yes, these really do exist. For less common non-refundable credits, we turn to Schedule 3 to capture those credits, and then report them in summary up to the 1040. After a quick subtotal, we inject some other taxes. Now, some of you may ask, why are there taxes first coming on Schedule 2 and then again on Schedule 4? This is actually purposeful. The tax law is designed to allow the credits we just discussed to lower your tax liability to 0, but only including those taxes we've mentioned so far. So the typical income tax, the tax on the kids' income, the AMT, and the repayment of premiums. The taxes on Schedule 4, by being included on the 1040 below those below those credits, does not permit those credits to reduce the Schedule 4 taxes. Hey, listen, I don't write the tax law. We're not going to dig in on all of these other taxes, but do note that self-employment taxes are here. Our next subtotal is truly our total taxes. This is the total of the income tax less any non-refundable credits plus any other Schedule 4 taxes that just happen to be collected as part of the income tax process. Now comes the settling up part of the tax filing process. The U.S. income tax does not permit taxpayers to wait until they file their tax return to make tax payments. The most common form of paying your taxes is through payroll withholding. Refundable credits are treated like payments as well, like items like the earned income credit and the refundable portion of education credits. Other forms of payment are captured on Schedule 5, the most common being estimated tax payments. Whether through withholding or estimated payments, the amount paid almost never matches exactly with the final tax liability computed when filing a tax return. As a result, there is a settling up process. If too much tax was paid in for taxes, then the taxpayer is going to be entitled to a refund. If too little has been paid in taxes, then the taxpayer owes money and will be required to pay with the tax return. If that amount is large, the amount you owe, then the IRS is going to assess penalties and interest for failing to pay taxes on time. In summary, here is how individual taxes are calculated and settled. This brings us to the end of our overview of individual income taxes. We're certainly going to dig in a little deeper next with coverage of deductions, exemptions, tax rates, and credits in the next 4 videos. So thanks for watching.